Hello and welcome to AI Market News by LM. Today's explainer is titled Yen Crashes Past 160. Intervene because we are currently witnessing an absolute perfect storm ripping through global trading floors. We're talking a historic currency collapse, some serious deep divisions over at the US Federal Reserve, surging commodities, and a critical slate of economic data right on the horizon. The US dollar is just flexing its muscles right now, and the Japanese yen, it just crossed a massive psychological line in the sand. So let's dive right into what this actually means for us and see how all these macro forces are colliding in real time. So here is the roadmap for our explainer today. First, the historic yen crash. Second, a hawkish Fed hold. Third, oil, geopolitics, and equities. Fourth, gauging market sentiment. And finally, number 5, the economic data ahead. All right, kicking things off with Section 1, the historic yen crash, breaking the 160 barrier. 160. We really have to emphasize that number because it is a massive psychological and historic threshold. The US dollar to Japanese yen pair didn't just touch it, it smashed right through it. This isn't just a standard daily fluctuation. This is a profound statement about the widening divergence in monetary policy between the US and Japan. And let me tell us, it's got traders globally on high alert for some kind of official pushback. Based on the prepared resources, looking at this spot chart brilliantly illustrates the sheer vertical nature of this move. We can see the dramatic plunge taking the pair all the way down to 160.47. To really put that into perspective, this marks the absolute weakest level for the yen against the dollar since mid-2024. And what's wild is that despite the Bank of Japan dropping hints about future rate hikes, the market is just aggressively testing their resolve. Traders are basically demanding actual action, not just words. And speaking of words, the rhetoric from Japanese officials has definitely reached a boiling point. We have this striking quote right here from Japanese Finance Minister Satsui Katayama. The time to take the decisive action we have been talking about is approaching. Now, various news commentary is widely interpreting this as a literal final warning to currency speculators. In fact, she explicitly urged the public and traders to keep their smartphones close by even during the Japanese Golden Week holidays. That heavily implies an intervention could happen at literally any moment, especially while market liquidity is super thin. When we look back at the history of Japanese intervention mounts, we really start to grasp the massive scale of capital required to fight a strong dollar trend. Just look at those previous spikes where the Ministry of Finance stepped in, spending literal trillions of yen just to drag the currency back down. The absolutely crucial point for us to think about here is whether unilateral intervention can actually reverse the trend this time, or if it's just going to be a temporary speed bump against the crushing weight of US dollar strength and these sky-high oil prices. Moving right along to Section 2, a hawkish Fed hold, division in the ranks. So, shifting from Japan over to the US, let's examine the central bank policy that is actively fueling this relentless dollar strength. The Federal Reserve has officially decided to hold the benchmark federal funds rate at a target range of 3.5 to 3.75%. As seen in the provided information, the Fed noted that while the economy is still expanding at a solid pace, inflation remains stubbornly elevated. It's just sticky. And that stickiness is partly reflecting the recent global surge in energy prices, which is basically forcing the Fed to maintain this restrictive stance for much longer than a lot of market participants initially hoped for. But here is where the plot really thickens for us. We're seeing some deep fractures within the Federal Open Market Committee. Governor Milan actually dissented entirely, pushing for a 0.25% rate cut right now, arguing there's just no compelling reason to wait. However, the pushback from the hawkish side, equally fierce. Regional Presidents Hamak, Kashgari, and Logan supported the rate hold, but they firmly opposed including any language in the official statement that suggests a bias toward future easing. They're pointing directly at the high levels of uncertainty surrounding inflation and geopolitical risks, making it crystal clear that a unified lockstep Fed is kind of a thing of the past. Which brings us to Section 3, oil, geopolitics, and equities. Basically, the triple whammy. A massive component of this market storm is, of course, energy. Brent crude is now nearing $125 a barrel. That is a 4-year high, levels we genuinely haven't seen since 2022. So what's the catalyst? Escalating geopolitical fears. Based on the prepared resources, markets are reacting to news that the US is mulling over military options and that an Iranian blockade extension could be on the table. For countries that have to import their energy, like Japan, this surging oil price combined with a dominant US dollar is pretty much an absolute worst-case scenario for inflation. Meanwhile, US equity markets are out here trying to digest all of this amidst a really heavy earnings season, and we are seeing a stark divergence in big tech. On one side, we've got Alphabet reporting strong cloud growth and proving to investors that their massive investments in AI infrastructure are actually paying off. But on the flip side, Meta shares dropped after they totally spooked investors by increasing their capital expenditure forecasts. It really shows us that in this high-rate, high-uncertainty environment, the market is brutally selective about exactly where it allocates capital. Let's pivot to Section 4, Gauging Market Sentiment, Fear and Greed. With these historic currency lows, a divided Fed, and surging oil, how is human emotion processing all of this? Well, to help us understand, we can turn to the CNN Fear and Greed Index. As defined here, it's a compilation of 7 different market indicators used to gauge whether U.S. stocks are fairly priced. It does this by measuring underlying market emotion on a scale from 0, which is extreme fear, all the way up to 100, representing extreme greed. It is an incredibly valuable tool for us when trying to navigate these highly volatile trading environments because it helps filter out the noise and lets us focus on the actual market mechanics. Within this index, there are a few key components we should definitely be laser focused on right now. Market volatility, measured by the VIX compared to its 50-day average, is a critical one as markets react to the Fed hold and those oil spikes. We are also watching safe haven demand, which is exactly where capital naturally flows when fear rises, as well as the ratio of put and call options. That ratio tells us if traders are heavily betting on further downside protection. Tracking these metrics helps us see if the market is just overreacting to the headlines or if it's pricing in genuine sustained risk. All right, final stretch. Section 5, the economic data ahead, preparing for the next wave. We've seen the setup, so now let's prepare for what's coming next, but checking out the investing.com economic calendar. Here is the timeline of key upcoming releases, and please note these are all in US time. We have a massive block of central bank actions starting in Europe with the Bank of England interest rate decision at 4 a.m., followed quickly by the European Central Bank decision at 5:15 a.m. But the absolute main event hits at 8:30 a.m. with a barrage of US data. We get the Q1 GDP growth rate, initial jobless claims, and most importantly, the core PCE price index. This is the Fed's preferred inflation gauge, and believe me, it will be heavily scrutinized for any signs that inflation is indeed stuck. So we're really left with a massive, provocative question. With US inflation proving sticky, Brent crude surging toward $125, and the Japanese yen teetering right at the brink of historic intervention levels, will this upcoming block of US economic data finally force the Federal Reserve to alter its hawkish path? Or will it be the final catalyst that triggers a coordinated global currency intervention? The stakes for global equities and forex markets literally could not be higher right now, and we'll be watching every single tick. Thanks for watching. Don't forget to like and subscribe. This explainer is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the explainer description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This explainer does not provide investment or trading advice. Please make investment decisions at your own discretion.